straight over to you, Walt. Hit it, baby. Tell me what we got going on with these 24 units. Where are they? Why do you like them?
What we're seeing is a lot of infill action. 20 years ago, if you drove from Fort Myers to Naples, you didn't see very much on the island. Sat vacant due to the market collapse that we experienced back in 2008, and design combined with really the superior location, that's led to this place having a continual 100% occupancy rate over the past 8 years.
Wow.
Yeah, phenomenal. But that occupancy rate always scares me a little bit. As we often see, the current management has chosen really not to improve the units over the years to keep pace with all the new construction that's coming up. So they're starting to move into the phase of functional obsolescence. And like most of the experienced managers, what they'll do is, they realize that they're kind of slipping behind the competition, so they'll keep their rental rates low. Well, over the past 4 years, rental rates in that area have surged. They haven't increased their rental rates at all. So that kind of leads to that 100% occupancy rate. The result is the net operating income is rapidly decreasing because even though they're not raising rents, guess what is going up every year?
Taxes, insurance,
expenses.
Costs.
Yeah. All their expenses are going up. So they're getting impacted, by not raising that gross rental income. So repositioning on this one, Dave, very, very simple. The acquisition price for this is going to be right around 3.7 based on its current condition and cash flow. That's what we're buying it off of. We're going to invest about $220,000 into the property immediately. Each unit's going to receive new flooring, paint, quartz countertops, ceramic backsplashes, new plumbing and electrical fixtures. We'll put a nice upgraded stainless steel kitchen package in for the appliances, and we're going to add high efficiency toilets, which are a huge, huge, huge benefit for you. We put a $450 toilet in, and right now we get a $1,500 tax break when we're putting in these energy efficient toilets. So, we're creating some advantage right from the word go, as well as improving the units. Now, as always, we will do these improvements tied directly to lease expiration, so we're not going to directly impact cash flow. So all those improvements will be done over the next 12 months. We're going to be doing some exterior work as well. There's some paint that needs to be redone. Primarily improved signage and upgraded landscaping really is what this needs to take it to the next level. So that's something that we're going to be doing immediately. With our unit size, when we look at the comparable properties in the area, we feel that we're going to be able to re-rent these at market rent very, very quickly. And that's going to increase our net operating income by a little over $43,000. Now, with the current cap rate in that market, that's going to translate to an increase in value of $700,000. So that goes straight to the bottom line when we liquidate.
Beautiful.
So, targeted returns, cash on cash with this one, 10.98 year one, and we're looking to gradually increase that year 5, 16.64. Internal rate of return based on that is going to be about 24%, and very strong equity multiple on this because we are able to increase the value so dramatically in the initial year. We have an equity multiple on this of 2.85.
Nice. It's bread and butter real estate for us, Walter.
Absolutely. Absolutely.
Bread and butter real estate for us. One thing I have noticed on the lead generation and the flow, I know the 81 that is in due diligence now for the final phase before acquisition was comprised of a 50, a 55, and a 26. Am I right in saying that we're underwriting and seeing a lot more of these smaller units? Maybe not a lot more, but a more consistent flow of these smaller units. Am I right?
We are. What we talked about back in March is starting to come to fruition. You have a lot of the small operators, they're starting to feel the squeeze a little bit. They're concerned about what the economic future is going to hold for them. They're just not professionals. When they acquire these properties, they leverage themselves pretty heavily into
volume business when it comes to the apartment complex investing like this. So being able to be set up and ready to go, not just one time, but every single time is key to proficiency going forward. So nice job. And then that cap rate in that market, what is that? Like a six? What is that? What's the cap rate in this market?
It's 6%.
6% cap rate. Yeah. So on a 6 cap rate, you're increasing that valuation you know, as you see there, 700,000. And then at time of disposition, the investors in the fund are participating in that upside at time of position. So it's debt plus equity when you